One of the biggest questions that beginners ask is, when do I actually buy and when do I sell in Forex? And the truth is, there is no magic button anywhere that tells you buy now or sell now. Successful traders make buying and selling decisions based on market condition, strategy, and confirmation signals. Think of it like buying a car. You don't just brake or accelerate randomly. Instead, you respond to the conditions on the road, the cars around you, the people around you, and traffic lights. Think of it that way. So yes, in Forex, you don't just buy and sell randomly. You read the market's traffic lights and act accordingly. In the course of this video, I'll walk you step by step to know when to buy, when to sell, and when to stay out of the markets. We will cover market structure, support and resistance, indicators, and even how news events play a role. So by the end of this video, you should have a clear picture of how to make buying and selling decisions as a beginner, so you can stop guessing and make well-informed decisions and hopefully make profits. So first, let's understand market structure. To know when to buy or sell in Forex, you first need to understand market structure. And market structure is simply the direction of price. Is price going up? Is it going down? Is it ranging? Now let's see what to do when the market is in an uptrend. In an uptrend, the market makes higher highs and higher lows. Each time, the market makes a new high that is higher than the last one, and the pullbacks don't go below the previous low. That is an uptrend. In this case, your job is to look for buying opportunities during the pullbacks, that is during the higher lows, and not to sell against the trend. When it's a downtrend, the market makes lower highs and lower lows. Here, the market is clearly heading downwards. In this case, you want to look for selling opportunities in the lower highs and not to buy too early. So now you know that the market can be in an uptrend and it can also be in a downtrend. And in an uptrend, you want to look for buying opportunities, whereas in a downtrend, you want to consider selling opportunities. However, the market can also be moving sideways. That's what we call a ranging market. When you notice a ranging market, you want to buy at the support and sell at the resistance. What this means is that you buy when price is at the bottom, that is the support, and you sell when price is at the top, that is the resistance. But be very careful. Ranges do not last forever. Eventually, price is going to break either the support or the resistance and move in a trend. Here's a mistake most beginners traders make. So most beginners, when they are trying to enter the market, they usually try to buy at the very bottom or sell at the very top. But professional traders, on the other hand, wait for confirmation of the market structure. Let's say you are trying to buy at the support. You want to observe, is the support line holding? Is price breaking the support line? You want to pay attention to the candlesticks that are forming and be sure that the support is holding. And when you've confirmed, then you enter the market. So you always want to wait for confirmation. That way you are not just guessing. The market has shown you a direction and you are following it. So you are letting the market move you. So now that you understand what market structure is, that is understanding market trend, uptrend, downtrend, or a ranging movement, the next thing you should understand is support and resistance. Now I have mentioned support and resistance previously. Let's go a little bit deeper into it so you understand and you are able to identify support zones, resistance zones, and you're able to trade carefully. Let's make a practical example by looking at this Euro USD weekly chart. So first, let's identify resistance, that is ceiling for sellers. Look at the top blue line. Notice how price has touched this area several times in the past, but just couldn't break higher. Each time, sellers try to step in and push price down, and that makes this zone a very strong resistance zone. And in this area, traders usually look for selling opportunities. Now to identify support. Support can also be called the floor for buyers. Now look at the support line. Observe how each time price drops to this point, it bounces back up, meaning that buyers enter strongly at this level. Now this makes this level a strong support zone. In this area, traders are looking for buying opportunities. Now, looking at this chart, the current market behavior, you can see that price is sitting around 1.0330, but just slightly below the support zone. This tells us a few things. If buyers defend this level and price bounces, it could be a good buying opportunity. But if sellers manage to break below and hold under support, then that old support becomes a new resistance and we would look for selling opportunities. Now, keep in mind that it is also possible for price to break the support or break the resistance and return back, and that support will hold. And when this happens, it is called a false breakout. So when you are trading using support and resistance, you want to be careful not to fall for a false breakout. And there are also times when a breakout is not false, when a breakout is actually confirmed. Let's see an example. Let's say that for Euro USD, price breaks above the 1.12540 resistance in the future. If it pulls back and retests that level before bouncing up again, that is a buy signal after a confirmed breakout. So when you confirm that price has broken out from the resistance line, it is a signal to buy. That is only when you've confirmed the breakout. And this same applies for support. When price breaks the support, it is now a sell signal once you have confirmed the breakout. Now, here's a quick practical tips for beginners before we move on. Don't buy or sell in the middle of nowhere. So you notice that price is returning, like after hitting the resistance line, price is returning to the support line. That is not a signal to sell. Wait for price to clearly reach a support or resistance and confirm its movement in whatever direction before you enter the market. Patience is one of the virtues of a good forex trader. So be patient. Wait to get a signal, confirm the signal, then you enter the market. Don't just enter at the middle of nowhere. So now you know where support and resistance is. In our chart example, we've been able to identify the support zone and the resistance zone. But now the thing is that price does not always bounce when it gets to those levels. Price will not always reverse when it gets to the support or the resistance level. So how do you know when to buy and when to sell? This is where candlesticks come to play, because candlesticks help you confirm whatever signal you've observed from the markets. Let's go back to our weekly Euro USD chart. Look closely near the 1.04495 support zone. Notice those candles with long wicks and small bodies. That is called a pin bar. A bullish pin bar at support tells us buyers are rejecting lower prices. So if you saw that here, it is a strong hint to consider buying. Still around the support, you would notice times where a big green candle completely covers the red candle before it. That is called a bullish engulfing pattern. It means that sellers tried to push the market down, but buyers came in with even stronger momentum. At support, when you see a bullish engulfing pattern, that is a signal to buy. And the reverse is also true for resistance. At resistance, a big red candle swallowing a green one is a bearish engulfing pattern, and it's a signal to sell. You will also see some candles with tiny bodies and long wicks at both sides. That's at both the support or the resistance. And these candles are called a doji. It means that the market is undecided. So when you see doji pattern, it means there's indecision in the market. At support or resistance, a doji can be a warning. It means something is about to change. If a doji pattern is followed by a strong candle in the opposite direction, it could confirm a reversal. Now, still on our chart, near the 1.04495 support zone, we've seen a mixture of long wicks and bullish candles forming. This suggests that buyers are trying to defend this area. If you see a bullish engulfing pattern or a strong pin bar here, that could be a green light to buy. But if a huge bearish candle closes below support, that may be your signal to sell instead. The golden rule is that support and resistance help you look out for buying or selling opportunities, and candlesticks tell you when to enter the market. Candlesticks are not just relevant when you are trading support or resistance. They are also relevant when you are using indicators, Fibonacci retracement. They are relevant for knowing when to enter the market. This is why, as a Forex trader, it is important for you to know how to identify different candlesticks. Know the different candlestick patterns so that when you see them form on the chart, it is very easy for you to spot them, and hopefully they help you make trading decisions. To understand candlesticks, candlestick patterns, and how to trade using them, you may want to visit mytradingland.com, go to our university section, and just take time to watch our videos on candlestick patterns. We have videos on single candlestick patterns, bearish candlestick patterns, and bullish candlestick patterns, double candlestick patterns, just different categories like that to help you understand how to identify these patterns and how to trade with them, because they are very important for Forex trading. Now we've seen how market structure, support and resistance, and candlesticks guide us. But sometimes you may need an extra layer of confirmation, and that is where indicators come to play. Indicators are not magic and they don't predict market direction. However, when you combine them with market structure and candlesticks, they can help to strengthen whatever signal it is that you've gotten from the market. So they can help you make better trading decisions. For example, let's see the moving average indicator. If you add a 50-period moving average to this Euro USD chart, when price is above the moving average line, it shows that buyers are in control and you should be looking for buy opportunities. And when price is below the moving average line, it means that sellers are in control and you want to look out for selling opportunity. On mytradingland.com, the university section, you can see our video on moving averages and how to trade with it to help you understand how moving averages work better. So you see how you can use moving average to confirm whatever signal you are getting from the candlestick and for support and resistance or the market structure. Let's also see an example from another indicator, that is the relative strength index indicator. So the relative strength index, that's RSI, measures if the market is overbought or oversold. Above 70, it means the market is overbought and price may be due for a sell-off. And below 30, the market is oversold and price may be due for a bounce upward. On this our Euro USD chart, if price dips below 30 near the 1.04495 support zone, that strengthens the case of a potential buy. And on the other hand, if RSI is above 70 in our resistance zone, that is a cue for a potential sell. Let's also use another indicator for example, and let's use the MACD indicator. The MACD indicator is used to show shifts in momentum. When the MACD line crosses above the signal line, it suggests bullish momentum, and when it crosses below, it suggests bearish momentum. For example, when price is like as the support and the MACD crosses upward, that gives extra confidence to buy. If price is at the resistance and the MACD crosses down, that gives extra confirmation to sell. The real magic happens when different factors align. For example, price is at the support and you see a bullish engulfing candle and RSI is below 30 and the MACD is also turning bullish, that is a high probability buy setup. The same works for resistance. So when you see multiple factors like this align, that gives you an extra layer of confirmation. So you see how all of these like intertwine and help you make decision whether to buy or to sell. You see how candlesticks help you to confirm support or resistance, and you see how indicators can also help you confirm what you are seeing on the candlestick. So you see how all of these together play a role to help you make informed buying or selling decisions. However, there's a mistake that beginners make. So because you know that indicators can be helpful, then you now overload your chart with so many indicators. You want to use 10 indicators to confirm a signal. The more indicators you're adding to that chart, the more confused you would become. So it may be a good idea for you to just stick to 1 or 2 indicators that you understand well. You understand how to use them. Stick to them and use them to confirm your signal. Don't overload your chart and confuse yourself. There are also other tools that you can use, like Fibonacci retracement. And even for Fibonacci retracement, candlesticks are helpful to make trading decisions, to help you confirm the signal you are getting from the Fibonacci retracement tool. To understand Fibonacci retracement and how to make buy or sell decisions with it, go to mytradingland.com, go to the university tab and watch our video on Fibonacci retracement. Or to make the process even easier for you, you can also go to MTL University here on YouTube and watch all of our helpful trading videos. You find them helpful. There you would also find the video on Fibonacci retracement, the videos on candlestick patterns, and just other videos to help you understand the basics of Forex trading. They are all free of charge, so make use of them. So now let's move on. Now that you've understood everything that I've been talking about, there's also something that plays a role in helping you make buy or sell decisions, and that is the market news. You also want to pay attention to important news that may influence price movements. News matter because currencies are tied to the economy. When news like new jobs, interest rate decisions, or inflation is released, it views how investors value the currency. That is why traders need to keep an eye on the economic calendar. For example, on the first Friday of every month, the US releases the NFP job report. If the report is higher than expected, the US dollar strengthens, and if it is weaker, the US dollar weakens. For pairs like Euro USD, a strong NFP report can push price down since the dollar is gaining strength. And if the NFP report is weak, that report can push price up because the dollar will lose its value. Another news report that you want to keep an eye on is interest rate decisions. Central banks like the European Central Bank or the US Federal Reserve set interest rates. A higher interest rate usually strengthens that currency, and a lower interest rate weakens the currency. So you want to keep an eye on the interest rate decisions for whatever currency pairs that you are trading. So if you are trading pairs that contain dollar, you want to keep an eye on the interest rate decisions of the United States. For pairs that contain euro, you want to keep an eye on interest rate decisions that influence euro. So you just want to keep an eye, know what is happening in different economies as long as you are trading their currency. So yes, before we move on, here are some tips that may be helpful to you. Always check the economic calendar before trading. If there's high impact news coming, you either stay out of the market or reduce your position size, or be prepared to trade the volatility. If you trade during news, expect volatility. That's big spikes in both directions, and be prepared for it. So yeah, there you have it. But whether you are making the decision to buy or to sell, one thing that is always important is risk management. You don't want to blow out all of your trading accounts in one go, so you need to manage risks. Forex trading is risky. Before you click on buy or sell, here are some questions you want to ask yourself. How much of my account am I willing to risk if the trade goes wrong? The golden rule is never risk more than 1 to 2% of your trading account per trade. So for example, let's say you have a trading account balance of 1,000 rand. If you risk 10%, that is 100 rands per trade. 10 losing trades will blow your account. But if you risk 2%, that is 20 rands per trade. Even after 10 losses, you will still have 800 rands left to keep learning and trading. So always remember that you are trying to protect your capital so that you have the opportunity to trade again tomorrow, because you can have a bad trade today and tomorrow may be good. But if you lose all your trading accounts on today's bad trade, how do you then trade tomorrow? No matter how convinced you are, so let's say that all the factors, the indicators, the candlestick pattern, Fibonacci retracement, all of them, they have all aligned, and you are so sure that this trade is going to be a profitable trade, you also want to use stop loss. Stop loss is your safety net. No matter how sure you are, always use stop loss. If you are buying at support, place your stop loss below that level. If you are selling at resistance, place your stop loss a little above. That way, if the market breaks through, you exit with controlled loss. Always keep in mind that when setting your stop loss, you don't want to set your stop loss too close to where you entered, because if you do that, a false breakout can hit your stop loss and maybe that trade would have been profitable. So you always want to like set your stop loss at a point where a false breakout will not hit it. So while you are trying to be careful, don't be overly afraid to the point where you set like your stop loss wrongly. Now, yes, I know that you want to make as much profit as possible, but that does not mean that you should not use a take profit. Take profit helps you like taking the profits that you've made automatically when price gets to a particular point. Failure to use a take profit, and let's say you just remove your eye from the chart to do something else and you come back, you may see that price like has moved so much in your favor and is now returning back, and because you were greedy and wanted to like take in as much as possible, you realize that you don't profit from the trade as much as you should have. But if you had used the take profit, when price gets to that point, you take in the profit and trade again tomorrow. So don't be greedy. Another place where many beginners go wrong is their failure to control their lot size. Using a big lot size can wipe out your accounts fast, so always control your lot size to match your risk percentage. And yes, sometimes using large lot size means that you are probably over leveraging, so you don't want to over leverage. So use a lot size that match your risk percentage. That way you can control your losses in case the market does not go in your favor. Don't be greedy. And speaking about being greedy, Forex trading can be an emotional roller coaster. Today, you are greedy and you don't want to take profits. Tomorrow, you are so afraid. You set your stop loss so close to your entry point. So you want to be able to manage your emotions and be calm. So yeah, small risks means calm mind. And when you like take very serious risks, you notice that you are more afraid, you are flustered. And when your head is not settled, there are chances that you can make much more mistakes. So avoid greed, avoid fear, be patient, and try as much as possible to have a calm mind. If today's trade happens to be a loss, take it in good faith and learn from like that trade, see the mistakes you made, and tomorrow you trade again. Hopefully tomorrow will be better. If you are consistently learning from your losing trades, you will see that you will start making like more profitable trades because you are learning. So take time to learn. Take losses as an opportunity to learn. At the end of the day, knowing when to buy or sell is not about luck. It's about reading the market, understanding the market structure, waiting for confirmations, and protecting your capital. You don't need to catch every move. You don't need to trade every day. What you need is patience to wait for the market, and when the market shows you a move, you go with the flow. If you found this video helpful, don't forget to give it a like, and of course subscribe to this channel, and we would like to know your thoughts as well in the comment section. So leave a comment so we know how you feel. If you have video ideas that you like us to also make, something that will be helpful to you in your forex trading journey, let us also know in the comment section. I hope you found this video helpful. Bye bye.